Our next question comes from Sean Ruman. You may turn your camera on and ask your question now.
Hi, Sarah. Thank you so much for taking the time to speak to us today. My name is Sean Ruman. I'm a candidate for Master of Science in Management and International Business at Ivey. My question to you today is, what factors do you consider most often when planning a strategic investment?
Oh, that is a very complicated question. It's a really long list, so I'm going to give you some high level details. So what we're looking, when we're optimizing portfolios, we're looking at mainly risk and return. So we're looking at expected return, historical returns, expected returns, standard deviations, Sharpe ratios. Those are sort of the main metrics that we look at. But there's a whole lot of other things that we look at as well, which is drawdowns, how they perform during different market cycles. So if we put a portfolio together and we want to say, like, how would it have done if this had existed in the crash during the financial crisis, or if it's, how would it exist during the taper tantrum of a couple of years ago, right? So we do look at different, so we do a lot of scenario analysis. We also look at, we don't rely on historical returns because, as I said, the last decade of returns in terms of bond returns in particular is not going to be the next decade of returns for bonds. So we want to look at both historical returns as well as expected returns, so that we're building a portfolio that can actually endure over time going forward, right? So I'd have to, like, the analysis that we look at is, it's upside, downside capture, maximum drawdown, Sharpe ratio, expected return over multiple different time periods, standard deviation. I don't know, those are the only ones that are coming to my mind, but there's probably 15, 20 other metrics that we look at the same time. The key for us when we're optimizing portfolios is correlation. So we were looking for uncorrelated assets to add to the asset mix because that helps with the diversification. And so, we're right now, because sovereign bond yields we think are going to be low for a long time, we're going to have pretty mediocre returns out of sovereign bonds. We're looking for uncorrelated asset classes that will provide some of the similar components to the portfolio that sovereign bonds used to do. So we're looking for income. We're looking for yields. So something we're looking at. Absolute return bond funds we just added. We're added a real estate allocation. We're looking at mortgages and infrastructure. So different ways to mimic the previous factors that sovereign bonds were adding to a portfolio. I don't know, that's a very long-winded answer to your question.
No, I get it. Thank you very much, Sarah.
Thanks.